logistics and delivery companies like FedEx are getting attention from long-term investors because people are spending more money online and that trend is expected to continue, which could add demand for companies like FedEx. But what's a fair price to pay for Federal Express stock? That's the question I'm going to answer in this video by doing a discounted cash flow valuation model on FedEx. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, I know this screen can be intimidating for some of you, but don't worry, I'm going to go through all of the numbers step by step, one at a time, explaining what everything means, and then finally coming to the conclusion and highlighting what I think is a fair price to pay for FedEx stock. So let's start with the free cash flow expectations. The discounted cash flow valuation model says that the company's shares are worth the present value of all of the cash flows the business is expected to generate between now and infinity. So you're paying for the business a price that you feel is a fair price based on what the cash flow it's expected to generate. You're not thinking about selling this business to somebody else for a higher price. You're just thinking about buying this business, holding on to it, and waiting for the company to generate cash flow, which you are entitled a percentage of that cash flow based on the number of shares you own. So those numbers, the free cash flows that are expected for FedEx are in 2024, $3.14 billion. And that's expected to rise to $3.5 billion in 2028. This is a forecast from Wall Street analysts that are following FedEx stock. And the reason I use Wall Street analyst estimates for cash flow, at least for the next few years, is because these Wall Street analysts have close relationships with the company's management teams. And the management team will sit down with these Wall Street analysts and have one-on-one conversations, either over the phone or in person, and describe to them their forecasts, their business prospects, and what they believe is what the company will generate in free cash flow. And so the Wall Street analysts are implementing the numbers that they receive from the company's management teams and also incorporating their own analysis. So they're not just taking the management team's word on what they believe they're going to deliver, but they incorporate that in their forecast. They incorporate the guidance given by the company's management team. From 2028 to 2034, I use my own personal forecasted growth rate for free cash flow. So I'm forecasting that FedEx will grow its free cash flow from $3.5 billion in 2028 up to $5.1 billion in 2034. The factor that will drive this growth is the increase in online spending. The increase in online spending is going to drive an increase in demand for delivery services, the kind that FedEx offers. And even if FedEx itself doesn't generate as much revenue from online sales, it will generate from the overall increase in demand for delivery as its competitors will devote more attention to that category. You may have heard the recent news actually that UPS is pulling back from its relationship with Amazon and focusing on more business that's more profitable because Amazon is so powerful, it commands lower prices for its services. And so overall, I believe this market will grow over the next several decades as more and more consumer spending shifts online. And if more shopping is happening online, things need to be delivered, and those deliveries will generate revenue for all participants. From 2035 onward, I'm using an interesting shortcut. It's called the terminal value calculation. And I teach this concept at university. The way you arrive at the terminal value is you take the free cash flow estimated 1 year ahead and you divide that by the company's cost of capital minus the expected growth rate over the long term. So the 2035 cash flow is 5.35 billion. The weighted average cost of capital I'm using is 9.45%, which I will go into more detail shortly. And the growth rate I'm using for the long term is 5%. Again, sometimes I get a comment in the section of the video saying, why would you use 5% when the US economy is only going to grow at 3%? You're estimating that in the long run, FedEx will continue growing at faster than the economy, and eventually that's unsustainable, right? Because then all revenue will just be going to FedEx if we extrapolate out that number to infinity. But let me counter that statement again, as I've said repeatedly. I'm using 5% because that's the nominal rate of increase I expect. I'm not using the real rate of increase. I'm using the nominal rate. So I'm not adjusting for inflation in these numbers because the stock price, the intrinsic value, is not adjusted for inflation. So I'm using nominal terms. That's why I'm using 5% and not 3%. If I was using inflation adjusted terms, I would use 3% or maybe 2.5%. So now that we've discussed all of these free cash flows expected between now and infinity, we need to take the present value of all those cash flows. And for FedEx, the present value of all those cash flows is $73 billion. The discount rate, the weighted average cost of capital of 9.45%. A company finances itself with debt and equity, right? Debt is a percentage of Federal Express's capitalization, and the cost of debt is 7.5%. I applied that by adding a risk premium to the risk-free rate of 4.75%. And the CAPM is the capital asset pricing model. And the beta input is 1.18 for Federal Express stock, the risk-free rate 4.75, and the market risk premium is 6%. The company has $34 billion in debt and a market cap of $66 billion. And so I give them a debt to equity capital structure of 55% debt and 45% equity. So when I combine all of that in the weighted average cost of capital, that's how I arrive at 9.45%. We're not done yet. We're almost there. So its value of operations are $73 billion. We need to add its cash balance of $5 billion and subtract the debt of $34 billion. We get a value of equity of $44 billion. We divide that by the number of shares outstanding of 244 million, and we get to its intrinsic value per share of $180. The current market price is $266. The intrinsic value per share is my estimate of what this stock is worth today, what each share is worth today. In other words, what I feel is a fair price to pay for FedEx stock. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.